Hello and welcome to focusIR. I am John Hewman and thank you very much for joining us today for a special edition looking at the opportunities in emerging markets. Given the rapid growth on offer in these developing regions, it's certainly an area that investors cannot afford to ignore. But given its scale, it's one that can be daunting for those wishing to access its many innovative and fast-growing companies. Impressively, emerging markets accounted for 50.4% of global GDP in 2024 and 65.9% of global GDP growth over the past 10 years. But that scale means it can be somewhat daunting for investors to get their head around. And with that in mind, we've assembled a panel of experts representing some of the most lucrative areas of emerging markets investing for today's roundtable. So first of all, I'm going to allow the participants to introduce themselves. Let's start with Charles Jillings of Utilico Emerging Markets. Charles, tell us a bit about yourself and what you specifically do in emerging markets.
So, John, thanks for having me on, and good to talk to you again. I manage, along with Jacqueline Broers, who is co-investment portfolio, an emerging market fund. By its nature, it's closed end, and we take a long-term view. And we are bottom-up investors. So we like to understand our companies, understand our investments. But our key, if you want, opportunity as we see it is the evolution and growing middle class and the infrastructure and technology change that's taking place. And we invest into that as UEM. So we have if you want, a focused portfolio. Our challenge is we invest in everything from Chile through to the Philippines. So very broad opportunity.
Yeah, very large opportunity, a very interesting area, the infrastructure, developing infrastructure of emerging markets. Let's turn to Thuy Anh Nguyen of Dragon Capital and manager of the Vietnam Enterprise Investment Trust. How are you doing, Thuy? Tell us a little bit about yourself and what you do.
Hi, John. Thank you for having me today. And it's lovely to be here with you and Charles and Ian. So I work as a product specialist director at Dragon Capital. Dragon Capital is the asset manager of Vietnam Enterprise Investment Limited. It is an investment trust that's listed on the London Stock Exchange and is a constituent of the FTSE 250. Dragon Capital is a pioneer in investing in Vietnam. It was established over 30 years ago, and Vail has been in existence since 1995. So Vail portfolio is consisted of 46 companies investing in a range of sectors, mainly focusing on domestic consumption and benefiting from the rise of the middle class.
And Vietnam's an interesting one because it isn't yet an emerging market officially, but it's knocking on the door of emerging market status. Tell us a little bit about that.
Yes, so Vietnam is still classified as a frontier market, but there is a high chance. We think that it's very likely that FTSE Russell will upgrade it to EM in their review this September. The Vietnamese government, the security regulator, has been working very hard, and it's actually a KPI at the highest level to get Vietnam upgraded as soon as possible. Because certainly in terms of market depth and size and daily turnover, liquidity, many criteria, is already as good as an emerging market, if not even better than some others. And there was a pre-funding requirement that was solved earlier. In November last year, that requirement was solved. So we feel that Vietnam market is ready for an upgrade.
Yeah, absolutely. Certainly a lot of investors seem to think so. It's been a very strong performer in recent years. And finally, let's turn to Ian Simmons of Fiera Capital. Ian, tell us about yourself and what Fiera does in emerging markets. It's a global investor, but with obviously a strong focus on emerging markets.
Yes, that's right. Morning, John. Fiera is a multi-asset asset manager. So we actually have an emerging market equity team based in London. The senior members of that team, including myself, have been working together for more than 20 years, investing across the emerging market world. And we invest in a very index agnostic way. So we really are there just to look for the inefficiencies, the mispricings, and to make investors money. We're not driven at all by what the benchmark is doing and telling us to invest. We really just think that the bottom-up approach is the best way to find the best 50 companies in the emerging market universe.
Yeah, absolutely. I think the bottom-up approach is something we'll touch on in depth. It's certainly an approach that you will take very sensibly. It's interesting that you mentioned the sort of mispricings and inefficiencies in the markets, because emerging markets have developed significantly over the last 2 decades. And sort of perhaps those inefficiencies are becoming somewhat more scarce. But let's talk about the evolution of emerging markets and where we've got to, where that's brought us through today, and what's made it, perhaps even more attractive as an investment destination today. Charles, what have you seen that's changed in the last decade or so?
Certainly, I think what has changed is the depth of the local market. So if you want banking and finance and all the support that you need to grow a local business, that has deepened over the last 20 years since we started investing. And if you want, there is a strong shift away from US dollar finance and all the risks that implies into local markets. I also think the local markets themselves, in terms of equities, have broadened and understood the opportunities on offer. At the moment, I think the emerging markets are probably held back by, in large part in Latin America, certainly high interest rates, which are compressing valuations because you can get a good return in debt. And emerging markets, even in Asia, I think are undervalued if you look at them relative to the global developed markets. Why is that? I think in part the US has hoovered up a lot of the capital, and if you want, that is starting to reverse. I think, you went certainly in the last 10 years, strong dollar, strong US performance. Investors found it readily or opportunistic to invest into that market. I think the emerging markets today are starting to offer a compelling investment opportunity. And certainly as US dollar weakens, interest rates look as though they are going to trend down in most economies, and commodities should hold up. It should be a good time to be an investor in emerging markets. Valuations themselves, everybody will quote, are cheap. They're cheaper than the developed markets. That's a given.
Indeed. Tui, is that something you would agree with? You've obviously alluded to the development of Vietnam's own markets and sort of capital reforms. What sort of is there anything you'd add to that in terms of things that have specifically happened in Vietnam, perhaps around governance, culture?
Yeah. Absolutely. So the last decade has been a decade of explosive growth for the Vietnam stock market. So the total market cap of the Vietnam stock market was $50 billion a decade ago, and nowadays it's around 300 billion. So a 6-fold increase in there. And the number of listed company has increased from 900 to 1,500. The number of listed company that has a market cap of over 1 billion has increased from around 10 to around 50. And we even have 4 companies with a market cap of over 4 billion US dollar. So, and the daily turnover has gone from around 150 million to average 800 million US dollar nowadays. So the breadth and the depth of the market has improved significantly. And alongside that is the increased participation from local domestic investor, which account for around 80% of daily turnover. So big changes there. And in terms of governance and disclosure, it's continuously improving, especially for example, I would say 10 years ago, not many listed companies have an IR department. Now, it's a very important department in listed in listed companies, and they all have really good English speakers. Many of them have studied and worked abroad. So there's a big emphasis on investor relations. Actually, some portfolio manager here I talked to that has just come back from a tour of Vietnam said he was so impressed with the ease of contacting and speaking to the IR department of the companies that he's investing in.
No, indeed, indeed, lots of very positive change on that front. Ian, I guess this, we've talked here about the opportunity set. You mentioned that you're trying to drill down to the 50 very best companies. What are you seeing in terms of sort of how that opportunity set is changing and the quality of companies that you're targeting might be changing to get to that 50?
It's definitely a much broader opportunity set than it was 20 years ago. Back then, maybe a bank and a telco company would cover the whole market for a while. But these days, emerging markets have become so much more integrated into the global economy, both as key supply chain suppliers, but also as viable end demand destinations in their own right, that it's opened up a huge new set of sectors and investments for those willing to look for them. I would add to what Thuy said on the governance. I think over the last 20 years, there's been huge improvements in transparency, in willingness of companies to talk to investors and understanding that it's beneficial for them to do so, to come to London, to meet investors, to attend conferences on the ground. And so the ability to actually do the job has vastly increased because now we have the access. At the same time, though, there have been headcount reductions on both the buy side and the sell side. So in many ways, those inefficiencies are still there to exploit and to find for those who are willing to do the hard work and look for them.
Yeah, indeed. Interesting you mentioned sort of broadening out of the kind of sectors that you can now access in emerging markets from, as you said, banks and telcos to a much broader set. And, both Vietnam and many other countries offer, tech, for example, is becoming a huge sector across these markets. Thuy, perhaps you could tell us about what Vietnam is doing in the tech sector. It's growing importance as a destination for technology sector investment.
Yes, as Jensen Huang once noted during one of his trips to Vietnam, the Vietnamese people seem to have a natural affinity to STEM subjects. So they make really good software engineers. So in the tech sectors, we have a leading company called FPT. We have quite a large allocation to that company in the Vail portfolio, and they have been exporting software services to Japan for a long time. And recently, they have also been expanding into exporting to UK, Europe, and the US. Last year, they reached their milestone of getting $1 billion of revenue from overseas services. And they are targeting to get $5 billion by the year 2030. And so this is quite a special, an interesting company, because when you think of Vietnam, you think of it as a manufacturing powerhouse of physical goods. But we are making progress in exporting services as well, especially software, as shown by FPT.
Yeah, indeed. And Charles, technology is obviously one of the big themes that is going on in the infrastructure space, putting that technology infrastructure in place that will drive the next phase of growth. Charles, tell us how you're targeting technology as a sector and perhaps some of the other mega trends that are a real tailwind for emerging market investing.
So I think just sticking with technology, the emerging markets, in my view, are standing on the shoulders of the developed markets. They didn't have copper. They didn't need to deal with legacy infrastructure. And so they very rapidly picked up, if you want, the digital economy. If you went back 20 years, one of our investments was in a company called China Mobile. And what was attractive, they were putting on 6 million customers a month. And it was extraordinary. But there was just raw growth. What we're seeing now is, they are going up the value chain and engaging on those digital platforms. So everything has exploded. I think COVID, much as in the West, has accelerated that because people needed to find ways to still sell their goods into the market. What are we seeing in an infrastructure sense? Clearly, data centers. So we have a direct investment in a data center in Hong Kong and one in Korea. And we have indirect investments in companies like FPT, who are also building a data center. I think the explosion in terms of the digital interface, be it at a consumer level, spending at, if you want, a teaching level in terms of schooling, at gaming level, at any level you look at, then you overlay the need to get into the cloud, which is what really got FPT going in Vietnam, was advising corporates about how can they get into the cloud. Now you've got AI coming along. So how do you optimize what you've just created? And that growth is extraordinary to watch. And, we ought to be able to find a set of investments that are compelling, and we have. I'm very excited about the outlook, and I think it's going to be around for 10, 20 years, because this is certainly the next step up. If you went back to, internet year 2000, everybody said, here we go. Well, we're back to here we go in AI. And I think the ability of governments to incorporate blockchain to make services much, much more efficient. People don't have to stand in line to renew a vehicle license. They can go online. And that is freeing up a huge sort of energy within the economy. The other three that we've identified are clearly energy transition itself. Energy needs to support GDP. If you're going to grow an economy, you have to grow your energy supply. But overlaid across the top are really two things. One is a movement to renewables, and they are all have quite ambitious targets to achieve a renewable balance within their energy supply, and increasingly energy security. I mean, I think the invasion of Ukraine has said to every government, you need to ensure that you can meet your energy security. Otherwise, your economy will fall behind. So a lot of investment going, a lot of dynamic, a lot of need for transmission lines. And we've got some fabulous investments in India and Brazil servicing renewable energy back to where, if you want, the manufacturing hubs are and the populations are. And I can see that growing for the next decade. The next one would be around social infrastructure. We still see a strong need across most economies for improvement in waste treatment, improvement in sanitization, improvement in transport. So if you want, rail and airports, etc. And that is unabated in terms of its demand. And then turning to global trade, yes, Trump is going to shift the dial again, as he did with Trump 1.0, there's no doubt. And clearly, Vietnam was a beneficiary. I think once we have certainty in the marketplace about actually what is the end point, I think business will shift and it will optimize the outcome. It'll look for, cheap labor, cheap land, good tax, support by the local government. But once it can find those opportunities, it'll shift and take advantage of it. And you saw that last time. And while it's uncertain where it's going to land on some economies, I don't think any of it is too concerning from where I sit. I think economies are well placed to grow within the envelope that Trump will set. So those trends, I think, will continue for some time, because even if you shift your trade, you could see, Mexico, if you want, benefiting from the North American trade agreement. And I think that'll continue.
Yeah. Indeed. Is it a similar picture at Fiera? Are these the mega trends, the trends that are sort of directing your portfolio to that top 50? Tell us a bit about the composition and also then how you go about finding them. Yeah, the process behind it. A lot of opportunity out there, but digging out to find those best ideas. How do you go about that?
Yeah, so first and foremost, we are bottom-up stock pickers. So the top-down, the themes, the macro, the politics can certainly help shape where we will go looking for ideas, but we have to be able to find the right stock at the right valuation before we pull the trigger to make an investment. But of course, yeah, these themes, Charles touched on many of them, and especially this idea of power generation, power distribution. I think that's a very powerful idea for the next decade. Not just emerging markets, but developed markets as well are massively investing into their grid. They know they need to upgrade the grid to not just make it more self-sufficient, but also handle the needs of renewables and these AI data centers, which are incredibly power hungry. So it's a theme I think will run, and there are several emerging market companies that build and make the equipment necessary for that. So how do we do that? We spend a lot of time on the ground. We travel very frequently, which I think is a bonus, which not many teams can do these days. We build up strong local networks with the local pension funds, the local mutual funds and investors, because often they can have a better feel for maybe some of the small and mid-cap ideas that the large investment banks don't cover. We're always looking for change, an inflection point. Maybe it's a macro change, maybe it's a reform agenda like we see in Saudi Arabia, like we see in Korea right now. These can generate significant long-term earnings uplifts. But it could be as simple as a company level inflection point. Maybe a new management or a new acquisition is changing things, opening up new revenue growth opportunities. So there are always so many things going on in emerging markets that one can find very diverse ideas around the world. But to be on top of those, to capture them before others, we need to be on the ground and very open-minded to looking at maybe stocks which have been discarded or overlooked by many investors for some time.
Mm-hmm. Tui, is it a similar approach at Dragon? Are you going through the same sort of bottom-up, pounding the streets, meeting management? Is that how you dig out the best ideas as well?
Yes, absolutely. And for us, Dragon Capital is unique in that we are based on the ground in Vietnam. So we have a team of 18 analysts that cover an investable universe of 80 companies. So they can really look at them in great details and get to know management teams in all the different companies that we cover. In fact, if you come to Vietnam and want to meet people from Dragon Capital research team, it's better to avoid AGM seasons because they're all busy going to all the different AGMs, getting to know the company really, really well. So that is our advantage there. And it the investment ideas of Vail and of other strategies within Dragon Capital stable is that we always follow. First, there's the top down, which is the big themes driving the country, and then it's the bottom ups among within those themes to find the top company. In terms of the big opportunities that we are investing in, is about the demographic dividend that Vietnam enjoys. So Vietnam is quite a populous country. We have over 100 million people. And the average age is only 33. So for every dependent person, we had 2 people in the working group to support them. And this is this golden population structure is set to continue for the next 10 years. Now, so the formation and expansion of the middle class has provided us with a set of very powerful opportunities. So the portfolio focus is on banks, which benefit from digitalization of the economy. We also focus on retails, especially on retailers that positioned themselves to benefit from shifting behavior of the middle class. For example, Mobile World Group, they were a market leader in consumer electronics, but in the past few years they have used their expertise to invest in a chain of modern grocery retailing. And last year, that chain made profit for the first time. And basically, they are tapping into the trend of people moving away from the wet market into modern retailing of, ready prepared food, groceries, air-conditioned department stores, etc. So it's companies like that will benefit from middle class formation and expansion that we are really tapping into. And the other company that we liked is real estate companies, because urbanization is still only 40% in Vietnam, and each year it's growing by an additional 2%. That's a lot of people moving from the countryside into the cities, and they all need housing. So demand for housing is still going really strong in Vietnam. And also there is a big program of infrastructure investment. The government has set aside $30 billion each year to invest in infrastructure, and this will benefit residential real estate company, and that is a big sector allocation in our portfolio as well.
Yeah, indeed. It's incredibly important, the infrastructure that's required to drive growth elsewhere. Charles, perhaps your focus is somewhat broader than TUI's. How do you manage that such a large pool of potential opportunities?
So I would echo both TUI and Ian. We're bottom up, and we've got a dedicated team that's been together. I think our collective team's age is over 100 years, and we've been investing in the emerging markets for now, dedicated for 20 years. And I think it's a bottom-up approach. You have to go and visit the countries. You have to understand the opportunity. And the opportunity in my mind is really threefold. One is the quality of the asset. Is the asset actually good enough? If it's a port, can it grow? Is it deep water? Is it shallow water? Is it well served by rail or not? You then have to look at the management team and their ability if you want to drive the value out of that particular asset. And a number of times you come up against investments where it's a conglomerate and it's just lost in the noise, and that's too difficult for us. So we tend to stick with the real assets. We tend to stick with assets where it has a unitary focus. It's a toll road, it's an airport, it's a data center, and then use our years of experience and knowledge about each industry as to what the real opportunity is. And then I think the third element is our processes and discipline. We build, models that go out 5 years. We try to then discount the value that we think can be achieved and look at the opportunity on, if you want, a discounted cash flow return, and use that model to then interface with the management team and charge them. But it's a bottom up. We've got 80 holdings, 30% or roughly 75% of the portfolio. So we really do concentrate our effort on the top 30, and it's a challenge to get in. And if somebody comes along with, I really like this opportunity, something has to go. And I think that's a really, really good discipline. And how do we keep abreast of the world's markets? We have deep relationships with strong local brokers who feed us information daily. We look at it not as a buy or a sell, but just raw information we can feed into our models and our expectations. The other thing I would note is when we travel, we'll tend to meet the corporate, meet the competition, if it's got a regulator, meet the regulator, meet the local brokers, and try and understand the opportunity in its round sense, because all these investments are in local markets, and you've got to understand that dynamic.
Yeah, indeed. Thanks, Charles. Ian, I was going to try and save the mention of trade wars and Donald Trump right to the very end, but Charles, you did get in there early. Ian, perhaps give us your view on the macro pitch. I mean, bottom up seems to be the approach, but we can't ignore what's going on in the wider world. Give us your view on these external macro headwinds, and perhaps why emerging markets have this time around seemed a little bit more resilient than they perhaps have in the past.
Mm-hmm. So one part of risk management would just be diversification. So we own stocks from many different countries, many different sectors. Some of them are more linked to global dynamics than others. Some are very much domestic stories. On the tariffs specifically, one way, of course, is just to avoid the nerves and to avoid that potential downside. So we did actually reduce our exposure to exporters into the US ahead of Donald Trump coming into power. We've since added back some of those. But really what we look at when we're thinking about the top-down risks is to buy quality companies. So companies which can do well regardless of what's going on in the wider world or at the macro level within their own market. So that's companies with strong balance sheets. We don't like leverage. Companies which generate cash. Companies which have high return on equities. Companies which have strong market positions. So perhaps high market share or strong negotiating power with their customers. So we've already seen actually behind closed doors, some of the Korean exporters into the US have discussions with their customers about tariffs, and for the most part, they've agreed that the US buyer will be the one who is paying for the tariffs. So that demonstrates their pricing power, that they are producing a good which no one else can do, and therefore, ultimately, the customer has to pay. So there is certainly a quality tilt, which helps deal with macro uncertainty. We've seen that time and time again through emerging markets. But also buying cheap. So you have some valuation protection, some downside protection. There's a lot more downside for a stock on 50 times earnings than there is for one on 5 times earnings with a nice dividend yield as well. So that's another part of what we look for. And then the other, as Charles referred to, when you've been doing this a long time, there's an element of psychology here. The market overreacts at the first sign of bad news. We've seen these crises before, whether it's COVID or the GFC or tariffs, whatever it may be. Generally, applying your experience and sticking to your process at those points is exactly the right thing to do, and to take advantage of the short-term mispricings, to maybe pick up stocks that you've already done the work on, that you would like to own, but now the valuation is 20-30% cheaper. So those can often be times of added turnover in the portfolio when you get a chance to snap up those names that you've wanted to own for some time.
Yeah, I guess you mentioned Korea, and that's a very interesting market. Obviously, it's very, world leading companies there, but behind the scenes, a lot of political turmoil, and that reform is likely to come. So do you also, in terms of that value approach, get in ahead of the reform that you feel may be on the way?
Yeah, Korea has been one of our largest allocations for some time, and also one of the top contributors to performance in the last couple of years, and that's really because I think there are a handful of companies there which were dismissed by many investors as cheap, cyclical, low-quality businesses. But actually, in the world of power grid equipment, defense, the nuclear supply chain, shipbuilding, we saw some quite significant changes in the last few months. These companies started to win orders from the US, from Europe, from the Middle East, and these export orders were about 3 times more profitable than their old domestic business. So there was a huge inflection point in margins from those. And then on top of that, you have a value up reform program, which the government is pushing to try and emulate what happened in Japan very successfully. And that's forcing companies to really improve their governance, to increase dividends, to conduct share buybacks, improve the return on equity, and improve the valuation. We're about 12 months into that. It's been very profitable, but I think there's a long way to go.
Well, good news for shareholders. Tui, perhaps talk about Vietnam and how Vietnam is finding itself a beneficiary of perhaps the shift in in trade flows, and also combined with, as you've already mentioned, this demographic dividend and a young workforce that's getting better and better educated every year.
Mm. Yes, so Vietnam was definitely a big beneficiary of Trump 1.0 when during the first term he dialed up trade tension against China, and that prompted many multinational companies to relocate their supply chain into Vietnam. So we were so successful with China Plus One that in 2024, our trade surplus against the U.S. was over $120 billion US. So that prompted the president then to put a very large reciprocal tariff of over 46% for Vietnam, right? But the news of the last week was that Vietnam has become the second country just after the UK to finalize a trade deal with the US, and that put tariff from goods imported from Vietnam at 20%, with 40% for goods that classified as transshipment. Now, of course, we still need a lot more details before we can assess the true impact. But initial assessment is that it's net positive, because 20% is a lot better than 46%, and then also we want to know, we need to wait to see what other countries, other manufacturing competitors, what tariffs is going to be imposed upon them. But China tariff is 55%. So in any case, Vietnam is still remaining competitive. So China Plus One will continue.
Indeed. Charles, obviously, you mentioned that trade and transportation is one of the key areas that you look at from an investing perspective. How are you interpreting this? And how important is that as a factor when you're looking at potential investments in, say, a port, as you said, or a railway?
So I think if you looked at ports, we have over the recent years shied away from China because of the trade war with the US, and it was clear that the Chinese ports were going to be challenged as their volumes fell. But the obverse of that was other global ports were seeing a rise in volumes, because the world's GDP actually grew under Trump 1.0, and I think my expectation is it'll grow from here going forward, because the world doesn't stand still on Donald Trump's imposition. It'll move forward and it'll continue to grow. I think if you talk to, say, the Philippines government, yes, they expect some softening in GDP, but they're talking about going from, say, 5.5 to 4.75. It's still a growth economy, and there is therefore still a growth in trade. A lot of the ports that we're investors in are origination ports, so they're exporting product, and a lot of that product is agricultural, mineral, and will continue. So if you looked at Latin America, I always look at Latin America as long on soft commodities, long on hard commodities. That'll continue. It's a question of where is it going to go to? Is it going to go direct to China, or is it going to go to Vietnam, or is it going to go, to India increasingly? I'm ambivalent. It's needed. There will be a shift, and therefore you can invest in those ports. Our top investment, interestingly, nearly over the last 20 years, has been in a company called ICT. And I think they underline everything. They have fabulous core of ports. And, historically, they've clearly dominated in Manila. But they have driven exceptional performance in terms of their margins. They've always been able to price up, increase the margins that they've been able to achieve. But overlaid on the top, they've acquired a portfolio of ports now across the world. And when they acquire them, they usually buy them cheaply, bring in all their discipline, and then drive the margins to achieve the outcomes that they want. And if you watch their compounding effect of growth in containers, increasing margins, growing number of ports, they've delivered an astonishing return over time. And very pleasingly, as a long-term investor, they've stuck to the ports. Yep. They've stuck to the business that they've understood, and they've delivered.
Yeah, indeed. I mean, it's certainly a lot of these emerging market companies and business activities that we just couldn't do without. Simply, the developing world cannot survive without the emerging market economy. So perhaps on that note, it's a good opportunity for us to summarise, why the emerging market opportunity remains so strong, and what you each specifically offer investors looking to tap into that. Perhaps Charles, we'll continue with you.
I'm happy to lead. I think everything that we've said, the urbanization and the growth of the middle class is a key driver to all of these assets. They're the community that are demanding increased, if you want, toll road access, increased fridges, and therefore more power. And I think that plays out in real assets that drive real cash flows, that drive real dividend income and real growth. Overlaid across all of it, it's cheap. I've never seen such a broad set of opportunities at relatively cheap valuations. I mean, UEM is trading, I think, at 6.5 or 6.1 times EV/EBITDA. That's cheap in my language. Good time to be an investor. And you'll pick up a yield on our stock of roughly 3.7% growing. And I think that's a good defensive characteristic while you wait for the markets to catch up on valuations.
Yeah, indeed. Thanks very much. Ian, what would your view be? Similar to Charles's?
Yes, I think one of the first things to do is to really take a big step back and not look just at the last 5 years, but actually if you look over the last 25 years, that really helps to remember that in the first decade there, 2000 to 2010, emerging markets tripled while the US index was flat. So it's just the last decade or so where there has been the opposite and where emerging markets have struggled. But they do have the growth advantage. They do have the valuation advantage. And maybe finally we have a catalyst to actually unlock those advantages. And that is maybe deliberate or not, but Donald Trump seems to have reduced that one-way bet on the US and the dollar. And so if the dollar starts to weaken, which it has, that's been the biggest pushback on emerging markets for the last 10 years for us when we speak to potential investors. Now it's loosened its kind of dominant regime. We might finally see some small flows out of the US into emerging markets, and it doesn't take too much to move the needle quite significantly there. So I think these markets are often seen as more risky and more volatile. But that's not always the case. If you look at what happened in COVID, actually emerging market central banks were in many ways far more orthodox than the West. We didn't see the same kind of fiscal largesse that we did in the US and in Europe with all the subsidies and the handouts and interest rates going to zero. In emerging markets, they took the short-term pain, but actually they came out of that crisis far stronger than the West in many ways.
Yeah, indeed. There is an alternative finally, and it looks like emerging markets. Tui, perhaps make the case for Vietnam and Vietnam Enterprise. Knocking on emerging market status. Is it time to get on board now?
Yes, I would definitely say so. So allow me to look back like Ian and say that if you had bought shares in VAIL 20 years ago, then you would have made 7 times your money to this point. And that's compared with about 4 times return in the Vietnam index. So looking forward, the prospect is still very exciting, if not even more, because we are still benefiting from the demographic advantage, the formation and expansion of the middle class, a strong program of infrastructure spending. And on top of that, there is the potential for EM upgrade that would be catalyst for foreign inflow. And also, I would repeat what Charles said earlier about valuation being very cheap. Now, one special point for the Vietnam market in particular is the very massive reform program that is going on. So the government initiated this program at the start of this year, and so far they have achieved big changes, such as they've merged the number of ministries from 19 and now it's down to 15. The number of provinces have been reduced from 63 to 34, so almost halved. And that means that is part of a drive to increase efficiency on by the government, making investing the investing process much easier for companies. Most significantly, the government has passed this Resolution 68, putting private economy, the private sector at the center of the economy. So currently, the private sector in Vietnam contributes to 51% of GDP. The government's ambition is to increase this contribution to 60%. And so growth target for Vietnam this year is 8%. And we are well on track to achieve that. So it's a very exciting opportunity with a lot of potential at the moment.
Yeah, absolutely. Reform programs that actually work, get things done. It's so fascinating to hear. And one of the many reasons why emerging markets are so interesting. We've heard lots of those reasons today: demographic dividends, improved governance, rapid growth. Absolutely fascinating. Thank you, Charles. Thank you, Ian, and thank you too so much for sharing your views. And thank you all for listening. It's been an absolutely fascinating discussion. Plenty of reasons to get on board in emerging markets. Thank you.